Hi, guys, and welcome to another edition of Talking Compliance with the Compliance Guy, Julian Williams.
Compliance guy.
Well,
It
you,
sounds
you
so
are,
cheesy.
unfortunately. And you guys
It
don't know
sounds so
who he
cheesy
is.
when you say it like that, mate.
So what?
It sounds so cheesy when you say it like, "Oh, Julian Wills, the compliance guy."
Well, I know, but it's you take it as it is, and people that's where people recognize you, right? So for the audience, if you don't know who he is, he's Julian is head of compliance at Finsure. But we're not talking about Finsure today. We're talking about all things relating to compliance in the mortgage broker space. And Julian is one of our regular contributors to the group, basically breaking down compliance and risk to more easily understandable is how I put it, simply because it's not a particularly sexy subject, and lack of a better word, a lot of people just don't know it. They just sort of rock around every day and just hopefully they try to avoid being slapped on the hand that they've done the wrong thing, right? But you can't I suppose walk around pretending you don't know stuff. Because that's no longer a good excuse because you've done something naughty. But that said, that's a quick introduction to Jules. If you don't know him, you do know him now. I just see him around. Go shake his hand, have coffee with him. He's actually a really nice guy, despite the way he looks. You know, he looks like a bit of a bikie.
And what's with the drive-by? Constant just drive-bys, mate.
I gotta do it because you're not in the same
right?
room. You're not gonna hit me, so I'm going to do that.
So you can't tell when we're online like this, right? But Deanne's about 2 foot shorter than I am. So when we sit together,
that's exactly why I'm doing these drive-bys while we're online. But anyway, mate, thank you for joining us today. What I want to obviously chat to you, because we're sitting in June, like the year's gone by just like that, right? And you know we've had the check-ins pretty much at the beginning of the year, at the end of last year, to see how things are going, especially with the introduction bid and so forth. People being scared, worried that the sky is going to fall over, and then we've got the things which some brokers don't actually know, which banks have been working, as well as AGAT has been working very hard in the background, which is the DDO or demand, design distribution obligations. Yep.
Yeah.
I said it right. I've heard it so many times that I keep on, bugging it up. DDO. Yes, but that's what it sounds. That's what it means. But anyway, so I'd love to get sort of like a review from you, mate. So that we are in June. What do you see? What do you think? Is the sky falling over, as some people think they are? So
look, Dan, and again, I suppose a couple of things that I want to address right off the bat, right, is yes, I am I'm the head of governance and regulatory change with Finsure, but what we're here to talk about today is not Finsure based, right? I've been saying for a while that unless we define as an industry, and unless we define what best interest duty is and what the outcomes should be, then we are going to leave that to an external party. Now, when we think back, and we had a lot of concern, a decade ago when the NCCP came into play. Yeah, so we replaced the Uniform Consumer Credit Code with the National Consumer Credit Protection Act, and ASIC's guidance at that point in time. And I mean, you read the original version of RG 209, and it's basically making reasonable inquiries, and there was a lot of concern, and the same as there is right now about best interest duty and all the change that we're going through. Now, what I want to say is a couple of things. I want to kick off by saying that best interest duty as a concept, I am in full support of best interest duty as a concept, and the reality is that brokers as a service provider, that's what we do. We provide a service. We don't essentially have a product. The product belongs to the lenders. Brokers are a service provider. But when you see the market share of broker increasing month on month, end on end, every reporting function, every reporting section, 63%, I think was the most recent figures that I saw, sort of in the vicinity of 60 to 65 billion per quarter now. You don't as a service industry. Yeah, you don't as a service industry increase market share unless you're doing the right thing. So realistically, brokers are doing the right thing, and we are acting in the best interest of consumers right from the outset. So if you accept the fact that best interest duty needed to be regulated, you by proxy or by de facto accept the fact that brokers were doing the wrong thing, and that's absolutely not correct. What we need to do at this point in time, right, is we need to combine as an industry. This is why I'm saying this is not a Finsure initiative, right? This is for brokers. This is for everybody in our space. We must have definable outcomes and repeatable outcomes with regard to best interest duty. And we've got to do it together. I engage frequently with Daniel O, and everybody at Connective will know Daniel's your head of legal, right? And Daniel and I, we get along really well, and we engage frequently to ensure that we're on the same page. And our thought process is very, very similar. Whilst we have a different approach, and there's that type of collaboration whereby we can work together. Now, if we look at it, now everybody's, your audience, Dean, you've got 9,000 odd members now. Congratulations. You're probably the biggest deal in the mortgage broking space. For the smallest man, but the biggest deal. But look, the reality is that the influence and the people that are logging into these types of sessions, we need to understand that unless we define, unless we're on the same page, these outcomes will be dictated by AFCA. Yeah, and that's the last thing that we want, because AFCA, they have the AFCA Act, and as a result of that, they're a league unto themselves and a law unto themselves. So we as an industry, we need to define these things, which is why this is not, like I said before, it's not a Finsure thing, man. This is for all of us. We all need to be on the same page, and I'm open to feedback from anybody that wants to give it. But at this point in time, we just want to take some really complex concepts and turn it into, some really simple deliverables for you guys. And when we look at it, so we had our Finsure, myself and Simon Bednar had an engagement session on Monday with some of the key lawyers and key counterparts at ASIC, and we talked about some of our reporting obligations, the things that they want to see, and it's all very, very positive. It's not something to be intimidated by or be afraid of. These reporting obligations, we're going to be looking at product selection, the hows and the whys of that. And a lot of the focus from an aggregator perspective, and it doesn't matter which aggregator you're with, guys, everybody's saying the same thing. It's very repetitive in the statement of credit assistance, and there's a lot of information that needs to be provided in this statement of credit. So the SOCA document, and around that narrative of, the selection of products. Now, some of the aggregators have chosen to have a key word count. We haven't gone down that path, but again, this is not a criticism of anybody that's gone down that path, because we're, until you know what the outcomes are going to be, everybody's just trying to do their best. But at this point in time, ASIC is looking to issue some requests for data, and it's all data driven at this point in time. How many loans have been subject to bid, product features, why the particular product with those particular features and this kind of thing. But our engagement with ASIC on Monday was very, very positive, and again, you've got to see this, Dan, because Simon Bednar, our general manager, who is a very close personal friend of mine also, but Simon's in lockdown, so he's got this nasty beard going on, he's not a happy guy. So the poor bugger, he was supposed to be on holidays in Hamilton Island last week, and obviously a lockdown came into effect. So I'm trying to explain to his very young children why they're not in the sun, just sitting on the beach.
I shouldn't laugh. Yeah. But yeah, I'd be pretty upset too if I couldn't go to Hamilton Island.
Again, so there's this huge bearded man. He's just not in a good mood with, sort of 10 lawyers from ASIC on a dial, and just like, oh, this is going to be a long day. But it was very positive. And ASIC's interpretation of this thing, again, is and engaging with these, high-level stakeholders at ASIC. And the feedback that we got from them is that they believe that brokers are doing the right thing. So again, the fact that it was regulated, I think, it's a very political play that came as a result of the Royal Commission, which again was political in my mind. And we look, back when I started working in this space, back in the 90s, but we had the Banking Act, then the Credit Act, then the UCCC, now the NCCP. Every decade for 40 years, we've had a change in legislation. This time around, the NCCP, being mindful, Dian, this thing was written in 2009, first published in 2009, came into effect for brokers in 2011. But 2009 to 2019, mate, that's a decade. It's been a decade. Every decade for the last 40 years, we've had a change in legislation. And this time around, they didn't change the legislation because our lending practices are sound. Arrears has not varied, no matter how much inquiry we do. So, I think where we've landed with this best interest duty is very political. I agree with the principle. I agree with the premise. But, did it need to be regulated? Well, if it needed to be regulated, why the hell is the market share continuing to increase? Makes no sense, right?
Yeah.
But looking at that.
Yeah, I'm going to ask you a sort of like sidestep a little bit, right? Because I think from the broker's perspective, that's what you just said is really high level to them and what I see in the community, right? Like, and most of it is around gripes in terms of turnaround times. What I do see is that there is a few comments going, okay, so I know that Red Bank has the clients can go in there and get an approval straight away, and whereas it would take me 4 weeks. So they've interpreted it as my in the best interest for their client that they tell their clients to go to the branch. I feel that's a mistake. I feel
don't do that.
Yeah, that's not your obligation, is it, to find out what the SLA is in the branch, or right?
Yeah, well, look, SLA is something that we're required to report to ASIC on, right? And how we measure that. But the reality is, unless the consumer is specifically stating that their turnaround time is their most important functionality, their most important ranking priority, then as long as you're transparent and again explaining to consumers, everybody. I mean, me personally, I've worked in financial services for the best part of 30 years, right? I know I look really young because I'm moisturized, right? But look, and again, even I've been in situations over my, throughout my life where, I've been, on the short end of some pretty average outcomes by banks, right? So it's not a tough position to explain to consumers, right? That, these some where you have a significantly different, I've got to be mindful, right? But where you have a significantly different outcome, one at branch level and one for third party, let's be mindful. And again, I think these are the things that we can remind ourselves of, right? And we can talk to the banks and talk to our BDMs about this in accordance with the code of banking practice. Forget all of the things that you've heard. Is it anti-competitive? By pure definition, it's anti-competitive behavior to offer one person a different solution to another. Yep, to offer a better outcome, right? That is by definition anti-competitive. However, let's put all of that aside and let's not bash the banks. We're all in a position where we rely on them as much as they rely on us, right? But let's look at it from the perspective of the banking code of practice. And the banking code of practice says that all of the subscribers must have adequate staff to deal with all of the requirements with regard to whether it be volume based or whether it be sort of complaints or if you lodge a complaint with a lender, they have, in accordance with RG 165, right? They have exactly 45 days to resolve that complaint to your satisfaction. Otherwise, you have an obligation to advise them that they're right to complain to AFCA. Yep. Now, again, if they don't meet those obligations, they would be sanctioned. There are significant issues that come, the significant outcomes that come with, systemic issues of not meeting those timeframes. So again, looking at their banking code obligations, these are things that we need to start raising. Now, again, Deanne, and they're really solid arguments. I say, what about the FBAA and what about the FBAA? What are they, MFAA and FBAA? What are they doing? And they say, what about the aggregators? What are you guys doing? And again, at some point in time, we've got to stop pointing the finger and stop saying, hey, it's your job. Someone's got to stand up and say, I'll do it. It's my job. I'm going to stand up for the broker network and I'm going to say, hey guys, this won't do. Now, being mindful that when you have, we look at some of the things that have caused these dramatic blowouts in SLAs, right, and turnaround times for brokers, cashback offers. If you're offering a $4,000 cashback and that product is designed to influence people to come to your institution, have adequate staff, for God's sake, have enough people there to handle the influx of the business that you're generating. That's not a stretch. Having people wait 40 days or 30 days, for a first touch on a file, that's unacceptable. And I agree entirely.
Yeah, so I've seen one of the sessions that went into this as well. And then we've had, the major banks, effectively complaining to say that, well, broker quality submissions were in effect. We've had things. Yeah, and then there's also issues with the pandemic, and then their overseas staff was affected. I say that
I don't accept COVID as an excuse. 12 months.
Well, it's a year down the track. It's a pretty lame excuse. That's the first thing. Then we had other smaller banks. You look at the likes of Macquarie and ING. They don't complain about broker quality. So what then becomes the problem? Is it the broker is the problem, or is it the bank's teams which are not training the brokers properly to have this issue?
Again, right. when we look at broker submission quality, right? I saw some statistics recently, and this again, this is not a Finsure thing. This is an industry-wide thing that 60% of broker introduced applications require multiple reviews, right? Now, again, you show me a statistic that says one thing, I'll show you a statistic that says another. Don't buy too much into the stat, right? But let's address that. There are quality brokers that will go first touch to formal approval pending valuation on a number of occasions. But there are, and we know it, boys and girls, we know this, right? There are brokers that'll throw a deal in knowing that the credit criteria requires 2 payslips and a bank statement and throw it in with 1 payslip. Stop doing it. You're punishing yourself. Now we're getting to a point in time where I genuinely believe where we have the sort of platinum clubs and tiered rewards sections for brokers with higher volume. Whilst I'm not in support of that being a volume-based incentive, we are heading towards a situation whereby we include the PQIS, so it's the performance and quality assurance standards of broker outcomes. So if you submit a deal, and again, just think about it from the perspective of what you would do as a human. You get these things through, and this is going to demonstrate how old I am, right? Because this is how it used to work when I was a youngster. The things come through on the fax. I'm sure you've got brokers that are members of Finance and Coffee that don't know what a fax machine is because they're too young.
Dude, I was a credit officer for Citibank, and we were receiving applications via fax. And then
by fax, right? So the app comes in, you see it, and you see it, and you see the broker's name on it. And this is a high quality submission. I'm going to touch it one time, and it's going to go to formal approval, right? Because you did it, and so did I. You go through and you pick it up off the fax, and you see it. You see the name. You go, no, that's going to be shitful. But you see the next one, you go, yep, I'm taking it, and you process it immediately. So let's, as an industry, right? So a lot of our training. So this is again some of the outcomes from our ASIC engagement is. What training is being provided to brokers. And again, we need to do better as an industry around the training functions. But the understanding for many, particularly newer to industry brokers or people that haven't worked, haven't got a lifelong experience in working in banking and financial services, Deanne, and not knowing these outcomes and thinking, hey, I'll do the client a favor, I'll submit it today and, I'll just get it in the queue. Guys, that's not the way to do it.
I get that. And I'll argue on the other side though. We've got lenders like, I'll use Macquarie again because it's just an easy target, right? If things are missing, they would actually pick up the phone and they'll wait for the broker to email it through and they'll action it then and there, right? Yeah. So I'm not saying that yes, there is going to be issues with brokers just sending half-ass deals. There will always be the case that a broker somewhere will send in a half-ass deal, but there are also brokers who generally send in the whole thing. But for lack of a better word, whether, in the days of fax, the fax machine can only accept 200 pages, for example, and it can't receive the rest. What about, the double-sided fax that didn't, and then you had all these issues where to the broker, they did send it, whether it was received on the bank's end is another thing. We now have an issue where when, some banks where hasn't been received, it goes to the back of the queue where it could have just been action inside 15 minutes because the broker would have had that documentation. That's what I'm trying to say. So
look, and again, if you're credit staff at one of the banks, you've got the top 10% of brokers are earning in excess of $500,000 a year, but that's a rarity. And again, if you are in that space, congratulations. Hey, I'm looking for a job. But, the reality is that these guys, they're subject to the same frustrations in life as the rest of us. You know what I mean? And they pick something up, and if it doesn't tick the box, they've just had a fight with their wife. The kids have taken days off school they didn't know about. The cat's got a broken leg. The dog shit on the carpet. All of these types of things. They get to work and they say like, whatever. I'm not. So again, just we need to be mindful of that. But from a professional standards perspective, if we do what we're expected to do now, how would you? And again, just pose the question to yourself, right? If your commission was impacted, if they touch it once, you get 100% of your commission. They touch it twice, you get 90%. Touch it 3 times. I'm in Costa Giovannis's office. He's standing out there. He wants to come in. I'm not going to let him. Again, if we're in a situation where you got 1%, if they only touched it once and it went to formal approval, would you do a better job?
Absolutely.
Would the queue come down if they only touched the deal one time? So we are responsible for our own outcomes in some fashions. But again, we need to say at some point to the banks, that these particular campaigns, it's going to increase your volume. It's going to increase inquiry. For God's sake, have enough staff to answer it. Don't make us wait a month before you pick it up to only look at it and say, no, I'm missing a payslip. So again, there are a number of things that contribute to these outcomes.
Yep.
I believe that everybody has some level of accountability, including us. Even the aggregators, how much training have you received on policy? Do you know what the policies are? So again, we've invested a fair bit of money in our concierge service. You just pick up the phone and say, what's the policy at this particular lender for this particular product? And they tell you, you must have 1, 2, 3, 4, 5, 6, 7. If you're meeting that, if you're doing that, let he who has not sinned cast the first stone. You're taking you back to my Catholic school days, right? Don't the people that live in glass houses shouldn't throw stones. If you're putting up perfect deals and you're having to wait, jump up and down, but if you, if you just throw it up and hoping for the best, then, we are our own worst enemy. But again.
All right. So let's, I'm just being mindful in terms of time because I'm still using the free version of Zoom. So I'm going to move on to something else, right? So obviously since the beginning of the year with Bid coming out, we've had, some broker businesses impacted with regards to, using products where, I'll talk in terms of the asset finance space, but really there are other businesses or lenders that can be impacted as well. But the brokers have the ability to dial up, dial down the interest rates. Now, since the beginning of the year, that space has been decimated is probably not the right word, but brokers don't, some brokers are moving away from that.
So because in addressing that, obviously we're talking about reverse flex, and so flex commission was prohibited under the act, and as an industry we came up with a solution where you have a base rate and you can write it down to suit customer outcome. Again, as a result of Bid, and I'll speak specifically to the provision, which is obviously conflict priority in prioritizing the customer's outcome over your own. If you have the ability to write the rate down, you must, if you are classified as a mortgage broker. Now, a mortgage broker is someone who engages in providing finance for mortgages over residential property in accordance with the regulatory guidance, right? So if you are in that position, prioritizing customers' outcome, and again, working for free sounds like a really shit deal, and it is, but that's the reality, and that's how it was drafted. Now, again, when we talk about regulatory intent, and the perversion of the regulatory intent, what we're looking at here is, the basic premise of best interest duty is just do the right thing. Yeah. And that's in simple terms, just do the right thing. Never was it, I believe, designed to prevent brokers from earning an income. I don't think that was the intent. However, we end up in a position whereby with the conflict priority, that's the outcome. And it's a perversion of the actual intended outcome. But again, that's the position we landed in. Now, I've recently had some engagement with a lender who has been very, very cooperative. I'll give kudos to the lender for that. We're not going to talk about who it is, but we've seen a situation whereby that has been entitled via a white label product. And I'm saying to everybody now, in the direct interpretation of the act, you should not be writing rates up. You shouldn't be increasing fees. You can charge a fee for service, a credit quote, but varying customer rate and customer outcome is absolutely not in the spirit of the legislation, whether that was the intent or not. So just be mindful. If you have the ability to write up and write down, you must write down as far as you can. I know a lot of people have got varying opinions on this one. I'm giving you a very clear, specific interpretation that we have that is supported by hundreds of pages of legal doctrine, right? The reality is that's what it says, and that's how it's been interpreted. And ASIC has given us those outcomes. They've told us very clearly that if you can write it down, you must write it down. Peter White from the FBAA has been very vocal in his objection to that. But again, he will tell you that's where we've landed on this. So again, when we're dealing directly with a mortgage product, boys and girls, don't do it. Don't do it. You will find yourself on the short end of a very short stick when it comes to ASIC sanctions. And again, the increase in ASIC's powers with regard to their capacity to fine individuals on these things, the fines are in excess of $1 million. And you just don't have that line. I mean, if you've got that line around, good luck to you.
Yeah, but if you did, it was probably buying in crypto, and that's not doing too well today, I believe. So yeah. But anyway, I digress.
The amount of conversations that I've had with people recently, they say, can I ask your opinion on Bitcoin? No, you can't. Yep. But yeah, just again, we're right at the beginning of interpretation, and you don't want to be on the wrong side of this stuff, And again, I will say that the people at that lending institution have been extraordinarily cooperative in helping us get to the bottom of that problem and sort it out. I know Daniel, again, I've had some in-depth conversations with Daniel. We're on the same page with regard to that. So again, all of the connective brokers, you can rest assured that you're in real good hands with Daniel O and Amanda Sterling. They know exactly what they're doing. So again, kudos to them.
Yeah. So in short, if you can change the rate, don't.
You've got to write it down,
Yep.
in prioritizing the customer's outcome over your own.
Yeah.
Now let me just circle back to you, because I wanted to address this just for the benefit of everybody. And the statement of credit assistance and the commentary from brokers. It doesn't matter where you are. It doesn't matter, which aggregator you're with. The commentary has been around the repetitive nature. Like, why are we having to write the same thing over and over and over again? So I just want to address that for the benefit of people, because sometimes a little bit more understanding might, it won't relieve the frustration, but it might help you to understand. So there was in reading through the regulatory guidance, and as I said early on in the piece, Jen, today, is that this stuff early on in the piece is going to be interpreted by AFCA. And in dealing with AFCA, you've got to understand the nature of the beast. Now, everybody's heard my ramblings about AFCA and these ridiculous outcomes, the unpredictable outcomes, and the increased cost that comes with dealing with it with institutions such as these, right? But what we need to understand is, when you deal with AFCA, it's not a court, it's not a tribunal. They have no formal powers of discovery or fact finding, right? And resulting from that, they don't work on a burden of proof. They work on a balance of probabilities. And these are the key differences between a tribunal and a court of appropriate jurisdiction, and their external dispute resolution providers or ombudsman schemes. Balance of probabilities, right? And when we compare that, the balance of probabilities versus, sort of the burden of proof in establishing, someone's level of understanding. Now, it's the same thing, right? You get caught speeding and you say, I didn't know the speed limit was 60, officer. He doesn't care. The speed limit is what it is, and these are the rules. And that's how this is going to this is how this is going to play out. So in anticipating AFCA outcomes, right? And they are extraordinarily consumer biased. I'm not going to get in trouble for saying that. When we deal with that, our obligation is to ensure that, the customer has some level of understanding with regard to the product that they're entering into. Yeah. That's written into the best interest duty. So in designing that, I've seen situations in the past. We know clawback has been prohibited with best interest duty, but previously you charge a clawback fee, right? So you have your credit quote and you say, this is the amount that I'm going to be charging you as a result of, if you terminate the loan within the first 2 years. The opening, at the top of the page, the regulatory guidance says it must say credit quote, it must say what the fee is for and how much it's going to be, not a percentage, not a, designed later, we'll tell you about it, it's unascertainable, must have an amount, the maximum amount that you can charge. I've seen these outcomes with AFCA where they say, yeah, the customer signed it. So the legislation says it must say credit quote, must have what it's for, must have the amount, and it must be signed by the consumer. And AFCA says, yeah, they signed it, but they didn't understand what they were signing. There's only one thing written on the page, Dean. One thing written on the page. And they said, no, they didn't understand. So in now interpreting best interest duty and being mindful of these ridiculous, pathetic outcomes, and just the stuff that you see from that external dispute resolution.
I can see you trying very hard to control your.
I'm trying so hard not to swear, right?
Yeah.
But again, now we build that into best interest duty, right? And our requirement to demonstrate that the customer has had some level of understanding as to what they're engaging in. So the reason for the repetitive nature, and it doesn't matter where you're at, guys, whether it be fast choice, plan, connective, AFG, Finsure, it doesn't matter, right? The obligation remains the same. So demonstrating. So what we say is the customer said they want redraw offset 3 years fixed. Yep. So you mark that in and you write it in, you write in the explanation behind requirements and objectives. Then you must compare, you must select, your selection must be from a range of products, and you must demonstrate why you select that particular product with those particular features from the regulatory guidance. So you give a product comparison and you say each one of these products has redraw offset 3 years fixed. Yes, oh, yes. And then you say, I'm recommending this product. So this is one of the key differences. Now we must make a recommendation, whereas previously you just, say this is the one, yeah? So now this is why I'm recommending this particular product with these redraw offset 3 years fixed. So again, the repetitive nature of the thing is designed so that when you present it to the consumer or when they read through it, it goes through over and over again. Now, again, being mindful if when you're working to a balance of probabilities, you might miss it once, it's just, whether it's justifiable or not, you say it one time, oh, no, I didn't get it. Yeah, well, twice, 3 times. So the reason that they're so repetitive, there is a method behind that madness. And it was, in a number of the regulatory forums that we engaged in industry-wide early on in the piece, the customer journey was one thing that was, sort of a very, very high on that priority list of things we had to get right. But again, it is repetitive for a reason, and that reason is to help protect us from the unpredictable outcomes of AFCA. So again, I know it's frustrating, and we're all of the different software systems, and we're working very hard. From our perspective, being very single-minded in this fashion. From a Finshaw perspective, we're working very hard to get pre-population on a lot of this stuff. We once you've entered it, it repeats itself. But again, it is a challenge, and I feel your pain. But there is a method to that, and there's a reason for it.
So all up, they can't say they didn't realize, they didn't know, because it was there again and again and again and again and again, right?
Again and again and over and over. That's what I say. My son's 13, right? If I've told you once, I've told you 1,000 freaking times, kid. Clean your room, yeah. That's the same thing.
My 11-year-old, he'll still do it anyway. But anyway, that's another thing altogether. So again, being mindful of time left. Let's see if we can actually go smash through this little thing called DDO.
DDO,
I think the majority of the broker market wouldn't understand it, because this is the stuff that the banks have invested a lot of people, assets, and time into it to get it right, I believe.
So let's address it, right? Again, it's from the Royal Commission. Design and distribution obligations. So basically sort of the gist. It's just the gist of the thing, Your Honour, for all those fans of the castle. So the gist of this thing, again, whilst best interest duty is do the right thing. The gist of this thing is if you're gonna offer someone a financial product, and it's not just credit, it's financial products. If you're gonna offer someone a financial product, you've got to have a target market for that. You've got to have it documented. And if someone doesn't fall into that target market, don't give them that product. Makes sense. Now, turning that sort of concept into a reliable piece of legislation and an obligation is a horse of an entirely different color. But in addressing that DDO, so what we need to focus on from a broker perspective, and again, I'm going to speak only to what I know, right? And again, I know I've spoken to Dan about this at Connective, right? Again, we're on the same page, so I can say openly to those Finshaw and Connective brokers, we're in the same place. Now, when it comes to the DDO, the lender must have a TMD, a target market determination. So if nothing else, the financial services industry, we're the best at acronyms. So DDO and TMD. Well, you'll notice, right? The NCCP
close to the military, right? I mean, I don't think any other industry has these many acronyms as
I challenge everybody to go through the phonetic alphabet, right? Alpha, Bravo, whatever it is. However, in doing that, look at Costa. He really wants his office back. So DDO, TMD. So the TMD, and you must offer that. Now, I genuinely believe that's going to make our jobs easier. And I speak for myself. And again, I know Dan's of the same opinion. This should make our jobs easier. It should make life a bit easier, because once you've selected your product, it should populate then. So you go through and you select a first home buyer, for example, and we'll just pick a product, right? So the MAV pack is probably not best suited to a first home buyer, because we've got lower income, lower servicing that can't utilize all of those things with an additional fee. So we take the basic, no bells, no whistles, no frills product. We say, this one we're going to, generally, a first home buyer, or, a lower income model. So we then, once the target market determination, it should be loaded into the aggregator system. You select first home buyer, and it should only give you the products that are available that have a target market determination with that market segment. Yep. So it should make that part of our lives a little bit easier. Then as we go through and we go through our ranking priorities, we're in meeting bid, where the target market determination should make life a fair bit easier. Yeah. And again, the gist of this thing is brokers, you don't need to be right up to speed with what the TMD, with where we're at this point in time, right? For you as a broker, you do your job, and me as the regulation and then the governance guy, I'll do mine. And again, don't worry too much about it. There will be a point in time. Now, it's not yet determined as to whether or not the broker needs to provide the TMD as part of the, sort of delivery and recommendation of the product, but you will need to speak to it. I'm recommending this product because it was designed by the lender for, your requirements and objectives, or, you're looking to refinance to reduce your rate, and then this product has been designed by the lender for that specific purpose. And here's a copy of the target market determination that explains the bills, the pros and cons. Another thing that's pretty big, a lot of talk around, in the aggregator forums and so forth and so on, is the with the TMD and product features, where you're selecting, sort of fixed rate disclaimers and sort of how do you best utilize an offset? How do you best utilize a redraw and all these types of things? And this is becoming a much, much bigger part of that conversation. Whilst it's not an obligation yet, I think, sort of the more transparent we are with regard to that. Now, ask yourself as a broker, how many times have you written a loan for a consumer where they have a redraw and offset and they're not utilizing it? They're not using it correctly, but they're paying the fee for it, and these are the types of things that we need to be mindful of, and that's exactly what the target market determination is going to, or it's designed to, sort of address.
Yeah. I would have thought more the issue would be the credit card rather than the offset, but that's another thing altogether.
Yeah, again, mate, and again, I haven't seen any clear demonstration of anybody deselecting the credit card. Again, applying for a mortgage, why are you giving?
Yeah, and
why are you giving them a credit card? They didn't ask for it. Again, the anti-hawking obligations that are coming, for not cold calling and not unsolicited offers for financial products. And again, financial products isn't limited to credit. Financial products includes accounts. Financial products includes insurances. So all insurance products must have a TMD as well. Yeah. So it's going to be interesting. I've read a few of them, and some of them are extraordinarily comprehensive and very direct, speaking to their target market determination. And some of them are very broad. So again, we're engaging with a number of people on our panel, a number of lenders, just with regard to feedback on those. And obviously Finsure with the vertical integration piece with B&K Bank, and working through to make sure that we've got some really clear guidance for that. Now I can say we're currently doing the rounds while I'm in Brisbane today. I'm in Queensland, and New South Wales ran up 50 points on those Queenslanders last night. So I'm living life real good today in Queensland.
The what? Yeah, what?
State of origin.
I know what you mean.
For all the people in Melbourne, rugby league is a game that we play with a ball that looks like an egg.
No, yes, that one. No, you forgot. I grew up in New Zealand, and I always found it was mildly odd that even the state of origin is a big thing in New Zealand as well. And it was always,
half the players are Kiwis.
That's probably why.
Just for the benefit of everybody in Melbourne, we call it, so it's called rugby league, right? It's played with a ball shaped like an egg, very much like AFL, a little bit fatter. We call it football, but you use your hands. You don't actually use your feet. So it's a really good game.
Indeed. But anyway, mate. Thank you.
Thank you.
Was that anything else you want to touch on before we run out of time?
There's so much coming from, sort of in the upcoming sort of 6 months with regard to, there's a lot of change going on for the broker market, right? And again, I say this with absolute confidence. Doesn't matter what aggregator you're with, right? We're on top of this. I engage with, and I've said Daniel's. It's like I've got a crush on the bloke, I've said his name so often today.
Sounds like
but again,
it.
I engage
I'm
really
slightly
frequently.
Jealous, but
No, when I talk to him, I only talk about you, Dian.
Well, that's better.
But again, we've got most of this under control. We're openly engaging with ASIC from a transparency level to make sure that we're on the right side of this. So again, overall, brokers, I think, are doing a really good job. As we see, market share doesn't increase in a service industry unless you're doing the right thing. So congratulations. Market share increases, volume increases. With all the stuff, I'd like to talk next time probably about positive cash flow investments and quantitative easing and the impact that that's going to have. Are we going to see some regulation over the next 6 years? I think once we get through this sort of economic recovery, heading towards a $1 trillion deficit, Jesus, that scared the crap out of me. Scared the pants off me, Jen. Scared the pants off me, and that's a horrible thought.
Yeah.
Are we going to see some regulation that comes around negatively geared products? Again, with quantitative easing and the printing of cash, inflation, we expect to see an increase in inflation, increase in foreign debt. How are we going to address that? So there's a lot in my mind at this point in time. I'd love to discuss that. I want to get back to doing this more frequently, Dian. I miss you, buddy.
Yeah, I mean, I think one of my this is on me, not on you. That I wanted to do this when we do it face to face, but obviously it just works out that doing it via Zoom, works out much more better. So
much more better.
Let's make this a more frequent thing. But thank you, Julian.
Yeah. Hey, this is as is said at the end of every date that I've ever been on. Let's do this again. Maybe we never do. Right. So I just want to reassure everybody, right? Again, from an aggregation perspective and from a general perspective, we're on the right track. Again, I understand the frustrations that come with running small business, and it does look like it's getting harder and harder and harder. We are trying very, very hard. And the truth is, right, it doesn't matter. I don't care where you're from. If you've got some real issues, you've got some real concerns, please feel free, reach out to me. I've removed myself. I no longer have a Facebook profile, right? Social media is destroying my life. But look, reach out to Deanne if you want some guidance or you want some assistance. It doesn't matter where you're from. get in contact with me, and I'm here to help. I genuinely, you know, these outcomes. I've spent my entire life working in this industry, right? I'm not going anywhere. I've accepted the fact that I'm not going anywhere.
That's a great industry to be part of, man.
My future is heavily dependent on the outcomes that are designed and that you guys as brokers come to. And I'm genuinely here to support you. All right. Whilst Finsure pays the bills, if you've got some concerns, I'm happy to engage with you. I don't care where you're from.
Julian, thank you so much for your time, mate. Okay.
Thanks, mate.